can get started. A few people may be joining shortly, but welcome everybody to our monthly Carbon Talks session. We're really excited for today's topic, something we've been talking about for a while. I've had a lot of interest in, and that is the US Inflation Reduction Act and how Canada's CCS framework compares. And we have invited a great panel to help us make sense of this, and I'll be introducing shortly. My name is Maxi Niwasa. I'm the manager of Carbon Tech Delivery at Carbon Management Canada, and I'll be facilitating the conversation today. Sorry, go ahead, Shannon.
Shannon Wilson. I'm the program manager for Carbon Next, and I will be doing a little overview of Carbon Next this morning as well.
Great.
So to start us off, it's with gratitude and respect that I acknowledge the lands on which Foresight operates are the traditional, ancestral, and unceded territories of the First Nations, Inuit, and Métis people. And me specifically, the land I gather on is the traditional territory of the Haudenosaunee and Anishinaabe peoples, and many of whom continue to live and work here today. This territory is covered by the Upper Canada Treaties and is within the land protected by the Dish with One Spoon Wampum Agreement. I encourage everyone to put their land acknowledgement in the chat so we can all be aware of everyone's locations together. And so as we mentioned, Carbon Next is a program run by our partners. So I work for Foresight Canada, who help accelerate clean tech growth across Canada. We have about a $1 billion economic impact since our inception. And Maxi, if you want to describe CMC a little bit.
Yeah, thanks, Shannon. Carbon Management Canada is Canada's national hub for industrial decarbonization, where we do a lot of work around industrial decarbonization, especially focused on enabling CCS, and we do this by applied research through, for example, work at our field sites, such as the Newell County facility, where we do cutting-edge CO2 injection and monitoring site, technical economic analysis, and also policy work. Thanks, Shannon.
No problem. And just a quick on our agenda. So we have about 5 minutes of opening remarks, really brief about Carbon Next. I'll go through it quickly so we can get to our great panel. We have 30 minutes of our panelist presentations. We have a moderated Q&A with Maxi in our panel, and then we have our audience Q&A period. So if at any point you have questions throughout the presentation, please feel free to drop them in the chat and we will be monitoring and ask them at the end. So what is Carbon Next? We are Canada's CCUS accelerator for new ventures coming up in the carbon tech industry. We operate on 5 different pathways within our program. So building a collaborative ecosystem, trying to get our ventures connected with industry to get them adopted, leveraging infrastructure, and our great Canadian CCUS research and technology network. We have our concierge service for that. Growing and scaling carbon tech ventures. So we have training, mentoring, validation, and capital that we help our ventures get access to build their tech solutions and get them to market. Driving domestic and international adoption by working with heavy emitters to get the tech adopted, and positioning Canada as a global leader in industrial carbon reduction technologies. So to support this, we have our different goals for our program by 2025. I won't go into detail on these, but this is how our program is monitored for its success. So we help support 10 or more CCUS ventures per year. We run challenges, and we actually have a challenge up and coming, so we're very excited to announce that soon. We release an annual thought leadership report that was just released last month. Thank you, Maxi, for doing the heavy lifting on that piece. And we look to partner with industry and get our ventures capital to support their growth. And so these are some of the CCUS and hydrogen ventures across Canada. Some of these are included within our ecosystem, but Canada has a very thriving CCUS tech atmosphere. And the last thing I want to highlight is we have our applications open for our 2023 Carbon Next cohort. So if you are a venture looking for support, please feel free to scan the QR code or go to our Carbon Next website on the Foresight website, and you will get more information about our cohort and how we can support your development. And with that, let's get to the fun part of the presentation. So we have a great lineup of panelists today. This includes Jared Dzuiba, chartered financial analyst who has spent over 15 years at BMO and now leads the oil and gas equity research for BMO Capital Markets. We have Dr. Matt Lucas, who is the managing partner at Tuatara Development Capital, where he provides capital and operating support to project developers, building the climate positive infrastructure of tomorrow. And we have Linal Perera from Svante, who is the business development engineer, and he is instrumental in developing carbon capture projects and creating a strategy to ensure the highest rate of success for construction and operation. And with that, I will pass it over to Jared.
Okay, thank you, Shannon, and good morning to everybody. My name is Jared Juba. I'm Director of Oil and Gas Equity Research at BMO Capital Markets. So I'm a financial analyst by trade. I'm not a CCUS expert per se, but in my specific role, what I do is produce comprehensive deep dive research on sort of themes that we see impacting long-term future of the energy business. And so it probably won't surprise many of you that we spend most of our time in the last sort of couple, 2-3 years focused on the sustainability of Canadian energy producers, and with CCS being, perhaps the main tool that they have to meet their emissions goals. So I'm going to do my best in 10-ish minutes or so to provide an overview of some of the factors that we see influencing what is a very complex long-term investment decision in Canadian carbon capture, and specifically why we think that Canada is in some ways losing ground with other regions, including the US with its recent IRA policy. So in the next slide, despite this being an obvious US political commentary, I thought it actually sums up the dilemma that we face in Canada in terms of CCS development so far. It's a bit of a game of chicken. We're talking about parties that have a common goal, but very different agendas. There's a common understanding that the energy industry plays a very vital role in decarbonization, and Canada can be a leader here in many ways, but the government is very highly sensitive to the optics of supporting industry. On the flip side, industry is simply not going to invest without certainty on project returns to avoid diluting shareholders. So far, from our perspective, Canada hasn't really struck the right balance on policy, and it kind of risks driving everyone off a proverbial cliff, if you will, in terms of reaching those emissions goals. So in the next slide, it just outline a number of key takeaways. I'm not going to go through it all in detail, but just to summarize, Canada has a fairly, I'd say, imposing approach to decarbonization that is not really aligned with the drivers that are needed to promote investment by industry. We have somewhat of a convoluted mix of policies that are sort of administratively burdening. None of them so far are particularly effective. And the approach basically ignores the fact that emitters have a duty to protect shareholders, returns on capital. And the reality is that a fairly high level of support is needed to raise CCS returns to acceptable levels. And then, the main carrot that has been provided, the federal investment tax credit, we think falls short. There is the possibility of provincial funding to supplement that, but there's still a lot of uncertainty around the future value of carbon credits in Canada. And I think that's the biggest hurdle possibly there is to investment today. Finally, I won't discuss it in detail, but I did note on this slide, we think that there are some very important long-term cost considerations that add real complexity to the investment decision, particularly for Canadian emitters. So with that, on the next slide, I always like to start by sort of emphasizing that Canada's energy sector is uniquely positioned from a global perspective to lead decarbonization and energy transition efforts. It's been a global leader in technology development and R&D for over the past decade. These efforts have been reflected in leading emissions improvements over the past 2 decades. And importantly, we think it's uniquely suited for carbon capture, given the large scale and concentrated nature of emission sources in Canada. And it's already a leader there in terms of operating expertise and infrastructure and having high quality storage options. In addition, on the next slide, the Canadian industry overall has fairly well-defined decarbonization plans and targets. It's probably the most comprehensive plan of any sort of industry within Canada. We use the Oil Sands Pathways to Net Zero project. For those that aren't familiar, it's the top 6 oil sands producers in Canada, as kind of a key representation of this throughout our presentation here. Pathways, as we show on this slide, has outlined a very comprehensive plan and technology roadmap to reach net zero, and that includes eliminating 22 million tons per year of carbon by 2030. Importantly, when we look at this roadmap, it becomes pretty clear that carbon capture is the largest lever that they have, and it's essential to meeting both industry's goals and government's decarbonization goals long term. So on the next slide, the federal government's emissions reduction plan for industry, unfortunately, is quite out of touch with this. It calls for a 42% reduction in oil and gas emissions by 2030. That's a 7 million ton per year logic gap compared to the pathways plan for the oil sands alone, for example. It is widely considered to be unachievable. It's not supported by existing technology pathways, or it doesn't consider sort of the permitting constraints and input scarcity issues that we're facing in this industry. And unfortunately, this approach, we think is kind of reflected in the type of directives that have been introduced to date in Canada, which deal slightly more in penalties and incentives, and I think disproportionately burdens certain sectors, for example, the energy sector and the proposed emissions cap that may be coming in. So all told, the sort of imposing approach, much less business friendly, we would say, than many competing jurisdictions. We think potentially misses a huge opportunity to leverage the industry expertise that Canada has that could help it stand out as a global leader. Another related factor on the next slide, Shannon, is that we think cloud's policy is just the financial strength of the energy sector in Canada, which is generating record levels of free cash flow right now, ironically, because of the strength of commodity prices. And if maintained, we sort of estimate that they could technically fund net zero carbon capture over time. So it's a major source of contention because I think there's public perception that the industry should be funding its own way. Of course, the sort of problem with the logic there is that it ignores how the investment decisions for these major projects are actually made, and that is that emitters have a duty to protect shareholder capital, which we discuss a little bit further on the next slide. The question is not about whether industry can fund it, it's whether CCS projects generate acceptable returns versus other prospects, and that includes returning cash and capital to shareholders. This seems to be partly ignored in the policy debate, but it is important because without competitive policy, we do think we risk capital leakage to other regions, and I think we are seeing that to some degree today. The problem is that most large-scale CCS projects in Canada simply are uneconomic without the fiscal support that does risk severely diluting shareholder returns. And in the case of large-scale projects like the pathways, for example, we model a return of just less than 4% at federal pricing without the fiscal support. So that's sort of an unacceptable rate of return on a large-scale project, considering cost of capital is probably in the range of 8 to 12%, and corporate hurdle rates are actually rising, just given rising returns in the commodity business. Now, of course, on the next slide, the federal government has proposed an investment tax credit for CCUS. On slide 9, we have a very quick snapshot of Canada's in comparison to the US Inflation Reduction Act, just for reference. Key differences: Canada is a refundable investment tax credit. It applies to upfront CapEx, offering 50% for capture and 37.5% for transportation and storage for projects that are sanctioned before 2030. It's half the rate after 2030. Whereas the US program is a per ton amounts tied to volume sequestered until 2033. In this way, Canada's system does actually offer quicker upfront capital recovery, but as we'll show, we think the overall extent of the offering is significantly lower than what's offered by the US IRA. Also importantly, the Canadian tax credit is not available for enhanced oil recovery projects like it is in the US. So again, kind of another example of the US having a slightly more business-friendly approach. And on slide 10, we do think, as we mentioned, that the Canadian ITC falls short of what's needed. When we distill it down, the investment tax credit equates to less than 20% of total costs for projects that are completed by 2030. And importantly, it's merely 10% of the total cost for net zero scale projects like the pathways out to 2050. And this is, as we show on this slide, well below a number of competing projects in other jurisdictions, including the US IRA, where we estimate it could potentially cover upwards of 2/3 of project costs for projects that are built by 2033. And then on the next slide, just in terms of returns, when you compare the policies on their returns, you see that the IRR for projects built by 2030 under the Canadian program is barely 4% compared to 13% under the US IRA. So that's just to give a quick sort of snapshot comparison of what we see for a typical project. And then on the next slide here, Western provinces, the positive, I guess, is Western provinces are in great financial shape. So Alberta is set to post record budget surpluses on the back of resource revenue. It's been suggested that the province step in to supplement the federal ITC in some form, and it's been suggested possibly as a capital deduction against the royalties that oil and gas companies pay. And we estimate this kickback, if it were to come in, would be substantial for Alberta's competitiveness, potentially bringing the total cost coverage up to 40 or 50% when you include it with the federal program. So that would have substantial, impact on the returns. On the next slide, just show that this slide just basically shows that the model return for a large-scale project would increase from that 4% to, call it, 15% range with provincial funding. So definitely within the range that's investable. However, the other thing that this slide shows is that return outcomes vary considerably depending on the price of the future carbon credits and offset markets. We think this represents perhaps the biggest uncertainty and hurdle to investment in Canada. And just to move to the next slide, there's really zero transparency from our perspective on what the future carbon credits are going to be worth in Canada, aside from an arbitrary federal price that's going to be applied to provincial carbon tax systems. But the problem is that these systems, to date are fairly fragmented. They lack stringency, and so it creates a risk of an oversupplied credit market, we think, long term. And until those policies or the stringency is improved, there's a lack of foresight there. And so from this perspective, we think, when we're comparing to the US IRA program, which offers projects, eligible projects, upwards of what would be equivalent to about $120 per ton Canadian, we think it provides better certainty of project returns. And it's probably a key factor motivating more activity in the US today than in Canada. And then, the government did recently announce a $15 billion Canada Growth Fund that's going to provide, amongst other things, contracts for differences to select projects. So this is essentially a hedge on the carbon price that's needed to meet a prescribed return. But there are limited details on what that means. And we think when you step back, $15 billion on an economy-wide basis is barely going to scratch the surface of what's probably needed to support net zero pathways and the larger scale hub development. So to us, this is another sort of window dressing policy. It's probably going to benefit smaller projects and not wide scale development. And then just to wrap up with a little bit of levity here, we're still very optimistic about Canada's potential as a global leader in decarbonization, but the policy has to evolve to better meet the interests of the investment community, we think. And it's going to take some time to settle out, given we're in a political climate where there's a lot of back and forth, and I think the ideologies guiding policy today aren't going to get there. So with that, I will turn it over to Matt.
Thanks, Jared. Thanks so much for Foresight and CMC for having me. My name is Matt Lucas. I lead Tuatara Development Capital. Email's up there in the top right-hand corner, so would appreciate the chance to follow up with anybody one-on-one afterwards. As the least known brand amongst the panelists, I'll take a few minutes to just explain what Tuatara Development Capital does. We provide the capital and operating support to de-risk climate-positive infrastructure, and that includes, but is not limited to, carbon capture projects. We provide something known as project development capital, which I'll define on the next slide, but that is typically pennies on the eventual, so our checks are up to $15 million, but that enables projects that are in the mid-market up to approximately $400 million, and that's US dollars. And we operate across the US and Canada. Next slide. So I mentioned that we provide project development capital. We're helping bridge what I would consider the third valley of death. So there's a whole bunch of different versions of this peaks and valleys chart, but the one here has 3 stages to the left: R&D, development, and demonstration, and that's typically covered through risk-taking venture or government funding. And so in R&D and development, you're doing your basic science and engineering, and then demonstration is typically you're doing some sort of a pilot. But as you try to bridge from demonstration in the world of risk-tolerant venture and government funding to deployment, where you're building infrastructure, typically with totally risk-intolerant pension money, there's a gap. And that's both a technology gap, but also a commercial and sort of investor appetite gap. That's where development capital comes in. So what we do at Tuatara is provide you the financial resources and the operating support to go from pilot to actually construct your project to where you are able to attract hundreds of millions of dollars in construction financing. That's both debt and equity. Next. So typical just notes about what project development capital and DevCap investment covers. We do not generally cover things like R&D, piloting, marketing, or corporate development. Those are things that are best left to your venture fundraising. In white text, this is typical use of a development capital proceed. We fund things like your site-specific engineering, the acquisition of the site, the salaries of your development team. A project financing, infrastructure financing is a very complicated legal arrangement. So there's often a bunch of legal and professional services there. You're negotiating contracts, so we'll cover that. Most project developers don't have the in-house technical expertise to manage an infrastructure project at the hundreds of millions of dollars scale. So you might work with a third party. We call that an owner's engineer. And then you might well issue debt. Maybe Jared would help you with that. And there are going to be preparatory costs to that. And so we would fund those. So that's a little bit about Tuatara Development Capital and how we can support the carbon capture ecosystem. Now, as the one and only panelist from south of the border, I have the unenviable task of trying to explain to you how the 45Q tax credit works. Next slide. So the 45Q tax credit is the tax credit that supercharges carbon capture in the United States. 45Q has been around since 2008. Then it was reformed again in 2018, and then was reformed again as part of the Inflation Reduction Act. So it's had a long bipartisan history. But I do want to be clear, the Inflation Reduction Act itself was not bipartisan. It's a little complicated. The legislative maneuver that enabled the Inflation Reduction Act is known as reconciliation, which is sort of an odd term for what is a partisan maneuver. The important thing, though, is that even though the IRA was partisan, there's an over 30-year history in the United States of tax credits having never been retroactively rescinded. And so therefore, in general, US capital markets feel very confident that the tax credits implemented in the IRA, including this reformed 45Q, are here and are stable. The second point is about tax credits, which are sort of a uniquely odd and American way of doing energy policy. There's some folks who say, oh, if you're not doing carbon pricing and denoting it in dollars per ton, it doesn't count. And I think that's a little myopic. The great thing about tax credits is exactly how much incentive you're getting. And as Jared noted, some of the Canadian incentives have a fluctuating price, and so you need additional mechanisms like contract for differences to provide certainty of what the incentive value is. In contrast, the tax credit's a little bit more transparent about what its value is. And then the third thing I just mentioned is how carbon capture is being talked about in the US political context. It used to be a way to delay phasing out of fossil fuels, right? You had enhanced oil recovery, or you had clean coal. And now that's really changed. We're now talking about carbon capture as part of a total decarbonization Paris 2050 strategy. And that's really critical for the industrial sector. It's unclear how you get, say, zero carbon cement or steel without carbon capture. And it's also important for carbon removal. Next slide, please. So these are a little dense, but I'm going to try to walk you through some of the high-level key points about the 45Q tax credit as it was reformed in the Inflation Reduction Act. The top table covers the value of the credit. It's a little complicated because it depends on both where did you capture your CO2 from and what is the ultimate disposition of your CO2. In the top row, if you're doing point source capture, you get either $60 US or $85 US, depending on where the CO2 goes. So if you do enhanced oil recovery, or you do beneficial utilization into product, you get the $60 credit. If you put it into saline storage, you get a higher credit. Now, direct air capture gets a special carve out, and we know that because direct air capture is a newer technology, it's going to need a little bit more incentive in the near term. So that gets you $130 or $180. And then these are, and we'll get to this in the next slide, but they're inflation linked starting in 2026. So these credit values will grow. Now, it's important to note that when you get a tax credit, it's not cash. You have to owe tax liability. And so that's where a lot of the shenanigans in tax credits come from, is you have to partner up a project that is generating tax credits with an entity, typically a large bank, that owes a lot of taxes and can monetize that tax credit. So we'll get to that in the next slide. The second table here is around minimum capture threshold. So this is how much CO2 or carbon oxides, because carbon monoxide also qualifies, you have to capture from a given facility. And generally, we break this into 3 buckets: power generation, non-power gen industrial, and then direct air capture. And compared to previous versions of 45Q, these barriers are much lower. You're trying to balance 2 things. You want to keep your minimum threshold low. So for example, direct air capture is only 1,000 metric tons a year, but you don't want it to be so low that you say do carbon capture on a slipstream and then claim that your entire power plant is decarbonized, and you get into some sort of carbon capture is greenwashing consideration here. So non-industrial power facilities, non-power generating industrial facilities have a pretty low threshold of 12.5 KTA a year, whereas the power plants have to provide a slightly higher threshold. Most importantly, they have to show that their carbon capture design capacity is 75% of their historic emissions. So that prevents you from just doing carbon capture on a slipstream. Next slide. A couple other key features. The tax credit runs for 12 years from the date at which the facility becomes fully operational. That's called the placed in service date. The italicized terms here are legal terms defined in the US tax code. Now there's this question about what happens on year 13. And that's a great question. In general, we see carbon capture projects financed in such a way that they depreciate to 0, and it would be okay to scrap them at the end of 12 years because of the policy uncertainty in year 13 plus. We do mention that the credit escalates in value with inflation starting in 2026. And to get these credits, you have to comply with prevailing wage and apprenticeship requirements. In short, this means that you have to pay union wages, and these wages are published by the US Department of Labor. Because of the complexity of constructing a CCS project, using union craft labor is almost a given in almost all circumstances. So this isn't particularly challenging, but it is a new compliance challenge just in terms of documentation that project sponsors will have to handle. And you do have to commence construction by the end of 2032. So we've got some time to get on with this. Now for brevity, there's a whole bunch of related topics that we could get into. The first is who gets the credit. In short, it's the person who does the capturing, not the person who puts the CO2 in the ground. The second topic is direct pay, which is a shorthand parlance for there are certain circumstances and certain projects where instead of getting a tax credit, the government just pays you cash. And that will be defined in forthcoming regulation. Transferability is the alternative to direct pay. That's where you take the credit from the project that might not owe a lot of taxes and therefore can't use the tax credit, and you transfer it to a taxpayer who owes a lot of taxes and therefore can use the tax credit, and that taxpayer then pays the project for that. We need to talk about how 45Q can be used alongside a tax advantage form of debt financing called private activity bonds. And then lastly, you can't get a 45Q carbon capture credit unless you can put the CO2 in a geologic reservoir. And in general, for the higher permit values, the saline secure geologic storage, that requires something called a Class 6 permit. And there aren't very many of these permits that have been issued. And so there's concerns about timeline uncertainty around the Class 6 permits. So lots of challenges and discussion topics. I'm looking forward to diving in. Over to you, Linal.
Appreciate it, Matt. Once again, my name is Linal Perera. I'm the business development engineer at Svante. I am really excited to be here, especially joining Matt and Jared, who just know a lot. So I'm probably going to learn just as much as all of you. But I'm here to represent Svante. We are a carbon capture technology company based out of Vancouver, Canada. Next slide. So this is currently just a good overview on just as a company where we sit in terms of where we have assets. So we have demonstration facilities, or most of our stuff is basically in Canada. We have a 30-ton per day demonstration facility with Cenovus up in Lloydminster on a natural gas boiler, as well as a 1-ton per day here in Richmond, BC on a cement plant with Farge. We also have our global headquarters, as well as our current manufacturing facilities in Burnaby. Recently, we've added to that by turning on our new demonstration facility with Chevron, which is a 25 ton per day on a once-through steam generator. This plant is actually unique because it has the flexibility to dope the inlet CO2 with pure CO2, so we can basically demonstrate not only low concentration carbon capture, but also high concentration at around 20%, which is very representative of basically what is in hydrogen production, which is why this facility is very useful for us going forward. The slide also gives a good summary, or not, getting ahead of me, Shannon. The slide also gives a pretty good overview on basically our partnerships. We have very key relationships with Kiewit for our North American projects, as well as BASF for basically our manufacturing of our adsorbent on a large scale. Next slide. So I really like this slide just because it basically gives a good overview of just the CO2 value chain. Specifically, when going after these projects, the biggest hurdle realistically upfront is the business case, and Jared and Matt have done a fantastic job on just breaking down the complexity just on one aspect of it. But the other aspect that I would like to highlight is very much the infrastructure. Basically because there's a lot of technologies available when it comes to doing the capture, but very much a question that's sometimes missed is what are you doing with the CO2 once you've captured it? Typically, this is involving pipelines for transportation, sequestration for permanent storage and or EOR, enhanced oil recovery, as well as utilization. A lot of these questions are sometimes not done upfront. That's sort of changing in a lot of the discussions I'm involved in. But very much it is a prominent question when going for funding for detailed engineering as well as large-scale plant projects. It's a key question, and very much that infrastructure does dictate a lot where projects do get developed, at least in the near future. Where we sit in this discussion is very much the capture space, so the separation of CO2 from nitrogen and post-combustion flue gas streams. For us, we're focused in hard-to-abate sectors. So in industry, this is like petrochemicals, lime and cement, the steel industry. We're also very big in hydrogen production because it has a lot of high concentration CO2 with very little contaminants. It's a pretty clean stream. And lastly, BECCS, bioemission carbon capture sequestration. These are the main buckets that we kind of play in, although we do have a partnership with Climeworks to diversify ourselves within direct air capture. Next slide. So just for the uninitiated, I'm going to take a quick pause on just who we are. We're a carbon capture technology company focusing on solid adsorption to do carbon capture. So for what that means is we develop our own structured adsorbent bed. It's basically the filter you see at the top that is basically adsorbing the CO2 onto it and then desorbing with steam to basically put it to what can be put onto a pipeline for permanent storage or utilization. Our process is very much 3 stages: adsorption, desorption, and conditioning, which happens in 60 seconds, really, really quickly. And the deployment of that will be in our RAM, our rotating adsorption machine, which is basically the image you see in the bottom corner. I'm more than happy to talk to anyone if you want to reach out privately, but just as an overview on where I'm coming from when I'm talking about carbon capture, I know it from this basis. I'm well aware of basically the nuances with amines and cryogenic, but realistically, this panel is more dedicated on project deployment, so that's more the perspective I'll try to provide. Last slide. So from our standpoint, we've done a lot of development of our technology and deployment of demonstration facilities. And right now, after the completion of our Chevron project, our finalization of our Series E round of financing, and a lot of development of our technology and process cycle, we are now in the position where we're just dedicating our resources to commercialization. And very much for us, it is incumbent to make sure that we go after the projects that have the highest chance of success. And for us, success means actually building, commissioning, operation, doing a lot of energy to do studies that stay in paper form and just go on a shelf is not really where we want to spend our energy. And for that, that's where we get a lot of focus in the US, mostly because of the distinction that IRA does for the business environment, as well as the infrastructure that's currently kind of developing, whether it's a lot of hub announcements for sequestration, whether it's the pipeline networks that are currently being developed. That is not to say that we are not involved in commercial scale projects in Canada, but most of those are centered around Alberta and the Alberta trunk line. There's plenty of nuances in those discussions, and that's kind of what the panel is about. So I won't dwell any longer on my introduction, and I'll let the questions fly. Thank you.
Okay, great. Thanks, Jared. Thanks, Matt. Thanks, Linal. I guess over to me. We'll be have about 25 minutes of panel Q&A, and then we'll give it over to the audience. My first question to you guys is that 3 months ago, Canada arguably had the most attractive investment environment. We had the investment tax credit, even though it has some flaws. We have a pretty high price of carbon at scheduled to reach $170 a ton. Of course, there's some uncertainties around that, but still pretty strong policy package. Has that really changed with the launch of the Inflation Reduction Act? Matt, you've commented a little bit on that, Jared, as well, but let's tackle this specifically. Maybe I can ask Jared.
Sure. I guess it's a bit of a matter of perspective, and in some ways, with the investment tax credit coming out, it was, I think viewed better than nothing, I suppose, right? But I think when you look at Canada from a broader perspective, and just outside of the investment tax credit and the possibility of reaching carbon prices of $170 per ton by 2030, I mean, Canada's sort of investment environment, I would say, is challenged in a number of different ways, and this was the case probably prior to the IRA, in my opinion. So even the 45Q, the previous version of it, still had, we thought, a slight edge in terms of the economics versus the ITC as it was proposed, largely again just because of the sort of quantum of the total project costs that it covered relative to the Canadian version. A number of European projects we showed in that one chart still had higher sort of cost coverage and better returns, we thought, than Canada versus the ITC. But I think the bigger thing too is that there's a number of other uncertainties that are creating political risk, I suppose, in the eyes of investors. That is, things like the federal emissions reduction plan, the cap on oil and gas emissions, concerns around a very lengthy permitting process. Matt, you mentioned the U.S. There's some concerns around the Class 6 licenses, but I think in general in Canada, we faced for a number of years a general hesitancy to put any sort of major projects forward if they're helping the energy industry. That political situation hasn't improved. In fact, it's potentially gotten more complicated with Bill C-69, and there's some provincial, federal sort of battling going on around that. We've also had, some political turmoil, I would say, an election of a new conservative leader at the national level, a new premier in Alberta, and then we're still waiting on a provincial election in Alberta this spring. So it doesn't really help from a political risk perspective. And then when we look at the IRA, once the IRA came in, it just sort of confirmed for us, from the economics perspective, that Canada is definitely falling behind in terms of the certainty around what returns are going to be on these projects.
The only thing I would add is, you have to remember in the US, the only big CCS EOR project was Petra Nova. It was on Jared's slides. And, that was abandoned because the price of oil went down, and then the value of CO2 is linked to the West Texas Intermediate benchmark. And so if you're an investor, you're like, wow, like the, premier flagship EOR project in the US the last 5 years was a donut. Like, I'm probably not going to do that one again. And then you combine that with the fact that the institutions that are the providers of tax equity, those are taxpayers who consume and monetize the tax credit, they tend to have focused in wind and solar, which is where the tax credits were previously focused. And so those tax credit shops have sort of ended up being green banks without sort of a formal remit. And again, it's just by disposition leads them away from EOR-based CCS and toward industrial decarbonization.
The only thing I'd add, just to tack on to both of those comments, is really around the certainty of it. In the US, having 45Q in place and having it as your base case is very different than doing a project in Canada where you're basically trying to project where the value is going to be and assume that it's going to be that in 2030 or if it's going to push out. Those are very different strategic conversations when you're looking at it from an emitter perspective. And that's very much what drives a different approach when you're looking at carbon capture between the two countries.
Okay.
The other thing I'd say, Maxie, sorry, just to round this out is, I mean, and to be fair, I guess, to the Canadian side of things, is, I think 2023 is going to be pivotal in terms of, there's still a lot of back and forth consultation going on, even though a lot of these things have been announced, like the emissions reduction plan, the cap on oil emissions. Like, I actually think there's a good chance that the government walks back on that somehow. Just in terms of, like I said, it's clearly unrealistic, and everyone's telling them so, right? And so I think that there's still some back and forth, and there's some policy related items that are still outstanding that are going to be settled in 2023, and hopefully get more clarity around the extent of the contracts for differences and things like that. So to be fair, in a world where some of these uncertainties do get cleared up, the Canadian policy, including, like I mentioned, the potential for provincial funding, I mean, it could be world class for sure if we get those things cleared up. It's just right now, there's a lot of uncertainty around them.
Jared, I'm holding you to that.
Okay, well, great segue to the next question. And you guys are kind of hinting at it a little bit about the certainty on the price, and I swear this is going to be the only academic question I'll ask. That is that economic theory says that economy-wide pricing of carbon is the best or most efficient way to reduce carbon pollution across an economy. In reality, though, some of the nuances that you're discussing, is this really the right approach to attract the investments you need for decarbonization in an increasingly competitive investment environment? So, Matt, maybe I can ask you to take
financial economies and political economies are not the same thing. And so, I think in the US, the economists got roundly sort of sent home after Waxman-Markey failed. And that was sort of the 2008, 2009, it was a traditional cap and trade bill. And the reason, without sort of political pontificating about this, is that there wasn't a constituency. Like, nobody likes cap and trade, I think. Whereas if you think about the Inflation Reduction Act, it's like a bag full of carrots instead of a bag full of sticks. And one of those got over the line, barely. And so we'll move forward with what works. And I wouldn't get so stuck about what's most economically efficient, because the perfect, sort of might be the enemy of good enough. The key thing, though, is tax credits, because you know what they're worth, financial markets value 100% of that incentive. Whereas when you have this floating variable incentive, whether it's a Canadian carbon price or in the US, say there's the California low carbon fuel standard, financial markets haircut this because you don't know what exactly they're going to be worth. And so you might wind up over incentivizing to compensate for this volatility or the uncertainty in the pricing.
Yeah, I guess I'd chime in and say, like, I think, the economic theory, might hold true if you had a universally adopted carbon policy and market, that would avoid the capital flight if, other regions have more attractive sort of incentives. And that is the case. We live in a competitive world, and there are certain regions that have more attractive investment cases than others. And so there is that risk of capital leakage, and there needs to be some, more bags of carrots to compete with, those different regions or to sort of avoid losing capital. And that's sort of what I see happening between Canada and US, being one of the main differences there is that, there does seem to be somewhat of a capital flight because of the uncertainty and because of the, more sticks versus carrots approach in Canada.
Okay. Great. Jen, maybe I can just ask you one quick follow-up question. You mentioned the contract, the difference. Can you just, at a very high level, describe to the audience what that is?
Yeah, I mean, like I mentioned, the terms of it are very unclear because this is going to be done on a project by project basis, we understand. But essentially what it is you enter into enter into an agreement, a contract with the Canada Growth Fund whereby it would provide or compensate or make a project whole if the price of carbon at the time, say in 2030, is less than what they need to make a certain financial return on that project. So it's essentially like a hedge, is the way that I think about it. Of course, the Canadian government, this Canada Growth Fund, they actually want to be recycling the capital. And so there would be a ceiling on these contracts as well, in terms of, say you need to have a 15% return, just totally making that up, 15% return, and you need to get $170 per ton to do that. And the carbon price ends up being $250. Well, the government, our understanding is that the government would take a return on that. So it works both ways. It caps projects upside, but provides a certainty that projects need to go ahead and develop it, if that makes sense.
Yeah, that's great. Thank you, Jared. Linal, I have a question for you. And so far, the focus has been on policy, very much so, but policy isn't everything. And you, as a project developer that's developing projects on both sides of the border, can you speak a bit about the other considerations for project success? Things like social license, access to capital, regulatory clarity, overall business environment. How do these compare in the United States compared to Canada?
I think we've kind of approached the business environment just from a lot of what Matt and Jared have talked through. As far as clarity, I'd say the distinction again is back to what I was saying before, is there's certainty now versus certainty to come. And that very much pushes off whether we decide we're going to critically look at deploying carbon capture, which facilities do we want to look at, which ones are close to pipelines, which ones are close to new emerging sequestration locations. Do we do that today, or do we do that in 2026? Do we start doing that at least? Those are highly involved, resource-intensive discussions, and there's a lot that goes into those. And obviously, emitters have plenty on their plate because they've got a whole other business that they're trying to go after. So the conversation on whether it's worthwhile for them to start looking at that today versus we can wait till 2026 to start looking at it is a very different thing. And then again, back to the infrastructure, having a place to put the captured CO2 is a huge part of this. Matt mentioned Class 6 permitting in the US. There's certainly a lot of conversations around trying to streamline that process, or at least trying to make it more clear on what is needed to make sure your application goes through. And as more and more go through, obviously that information gets disseminated across the board. But again, it's a growing part of the industry. But as you develop that, there's plenty of locations within the US that have really good geology. Whereas for Canada, it's a little different, and it's a little bit more centralized in certain provinces versus, not to say that it's across the state lines when it comes to the US. There's definitely regions that are higher, but there's definitely a lot more spread out opportunity within the US.
Thanks, Linal. Jared, Matt, you guys want to add anything to this question? Go, Jared, you're muted.
Yeah, I mean, I think there's a number of different, factors here to consider. I mean, social license is a big one in Canada. I think it's going to be everywhere to some degree, but certainly the negative perception I think that the government and the public has about Canada's energy industry, for example, is a bit of a challenge. But then also sort of an extra layer. We do a lot of consultation with Indigenous communities, for example, and that's a bridge that we haven't yet crossed, specifically with the CCUS piece of things. And I think we're going to see, how that unfolds as sort of the pathways, for example, starts working on their project and other hubs start to develop. But that's an extra layer. I mentioned in my presentation long-term cost considerations. I think this is an important one for all CCS projects, but I think cost inflation and concerns around, so we talk about this complexity curve, that being that as we go sort of further out and address longer term sources of carbon that need to be captured, they're typically more complex. They have more contaminants and things like that need to be dealt with, and the cost of that is likely higher. In Alberta, we have a long history of cost overruns and challenges with labor and equipment scarcity, and if there's sort of a decarbonization boom, if you want to call it that, I think we're probably going to face some challenges more so than other regions because of that. So it's something that we have to, going back again to like, what's the certainty around the returns of these projects? That's something that these long-term net zero style hub developments are thinking about.
Great. Thanks, Jared. One quickly out on the social license, we touched on it a little bit. I do want to highlight that Canada, we do have some success stories. The Alberta carbon trunk line, the world's largest CO2 pipeline, essentially went ahead without any public opposition, which is quite a feat today. Let's move on. Matt, I have a question for you, and that is our perception here in Canada is that the US does much better at executing large-scale resource projects. Is this correct, or is there more to this question?
I mean, I'm not sure anybody in the U.S. thinks the U.S. is good at building large-scale infrastructure, right? It takes, right now this is coming up in the context of critical minerals and how it takes, a decade plus to site, build, and commission a new hard rock mine in the U.S., right? There's lots of NIMBY issues. Same thing happens in, say, electricity transmission. So just to say, this is not like a uniquely CCS conversation. This is, I think, like an energy transition writ large, power materials, everything conversation. That has largely been wrapped up under the context of permitting reform. In the U.S., there's something called NEPA, National Environmental Protection Act, and that's a landmark environmental law that requires a bunch of process before you do a infrastructure project over a certain scale. NEPA compliance can drag on for years and is sort of one of those things where everybody acknowledges it's important and it's broken and nobody's exactly sure how to fix it. As you can imagine, that going sideways if you open that box up in the wrong way. So I don't know that the U.S. is better or worse. I think what we're largely talking about here is certainty of incentives and then depth of capital markets. And that's the key differentiation.
I would add, I guess, that it's a matter of perspective again, and being from Canada and seeing the challenges. I mean, not to downplay that there are probably challenges in the U.S., but never used to be the case. In Canada, we have a world-class oil manufacturing business, the oil sands, right, which is a huge success financially for our economy. But now it's way more challenging, right? We have more of these layers of environmental assessment that has to happen. With Bill C-69, I think there's a lot of uncertainties around what that actually means. But just going back generally to, I think the sort of approach that the government has on energy projects in general is not sort of forward thinking in the same way as it is in the U.S. And when I think about the U.S. and the types of more recent large scale growth opportunities that have happened in LNG, right? LNG, petrochemical growth, and even just the Permian and the other, oil and gas shale developments are massive undertakings that have been successful, I would say, from my perspective. LNG, I think, is a great comical example. We recently shot down a potentially huge deal to supply Germany with, sustainable natural gas for Canada because there was no business case, which I think is ridiculous. But I think that's the difference in the attitude, right? And I think that goes a long way in terms of whether we're actually going to get these projects done or not.
Okay, so that's a great segue to the next question, and this is going to be a short take from everybody making the round. And we touched a little bit about carrots and sticks. And this question is it fair to characterize the difference in approach to CCUS and climate policy more broadly as that Canada is essentially primarily pursuing climate policy and with a key backbone policy with strong price of carbon, and the US is primarily pursuing industrial policy where the key driver is tax incentives and production tax credits to entice investments to come to your shore. We had a prep call. This had some good debate on this, so I just thought we wanted to share this with the audience. And maybe I can ask Linal to go first.
I was more interested to see where Matt and Jared fell on this first, but I guess from our perspective, it's very much Canada has taken more of a stick approach to going after CO2 and kind of saying, hey, you got to do something about it. Whereas the US has very much given a carrot approach to those that are considering it. Hey, there's an avenue for you to go after this, and they've definitely priced it in a way where if the structure around not only the transportation and sequestration makes sense, but also the capture plant, whether it's the utilities that are available at site, the logistics around a lot of the other infrastructure associated with those projects, you can certainly have a very viable project across the board today. And obviously there's other nuances to that statement, but realistically that drives a lot of incentive to like, hey, I want to look at this, I want to do this. Whereas Canada, it's just, hey, we need to look at this because at some point it's going to be too expensive to operate, and we need to do something about that. I'm sure Jared and Matt have more nuances that they want to add, so I'm just going to let them debate a bit further on it.
I guess from the Canadian perspective, I would call it more of a hodgepodge than a specific focus. I mean, I would agree with the the approach of Canada is more sort of a punitive approach up until now. But of course, we've and when you talk about, so you're right, there's the backbone of the federal program is output-based pricing systems and a carbon tax regime, provincial carbon tax regimes, but it's very fragmented, right? We don't have a national market or a national system. And the way it's structured is not very effective. I mean, you look at Alberta's tier system, for example, it is a facility-specific benchmark that they use to sort of determine whether you're meeting your benchmarks or your performance over time, and that really only incentivizes a reduction of maybe the top 10% of emissions. So the stringency isn't there, and so not promotional of carbon capture in and of itself, right? And then you have the investment tax credit and some of these other clean fuel standards and things like those that could pancake, and I think those are actually more motivating of CCS than the carbon pricing system is at this point. So just guess answer your question. It's a bit of a hodgepodge right now, from my perspective, and that's part of the inefficiency, the issue of the inefficiency of it.
This need to declare things as either climate policy or industrial policy is just very artificial, right? The beauty of Build Back Better or the Inflation Reduction Act is that you can kind of see whatever you wanted to, right? I mean, if you start Googling, American press coverage of the Inflation Reduction Act, you saw it called industrial policy, climate policy, a jobs bill, a defense bill, right? I mean, the more in renewable electricity in this case that the United States is making domestically, that's less that you're worried about, say Russia being concerned about, or it's also been called a resiliency bill and then a health bill, right? Because as you reduce not just CO2 emissions, but criteria pollutants, NOx, SOx, particulates, that's great for respiratory health, right? California is one of the leading jurisdictions in this regard, but most of California is a non-abatement area. It has some of the worst air quality in America. That's what drives some of these air pollution challenges. So it's all wrapped up, and I think the fact that we can get the win-win-win-win-win all lined up, and let's not leave us off the economic win there too, is great, and we shouldn't worry about the label so much.
Okay, great. Thanks, Matt. We want to move to the audience Q&A, so I just have one last question for you guys, and it's a good segue, and that is what we can learn from each other. So what are the top things that Canada can learn from the US approach? Maybe I can ask Jared that question, and we of course touched on this already, but.
Yeah, I guess it'd be mostly a summary of sort of what we've been talking about, but I think there needs to be more of a balanced approach, I guess, between the sort of hardcore climate policy and what the impact that it has on the economy. The US seems to strike more of a reasonable balance between these things, supporting industry when it knows that, they're a core part of bridging the gap, decarbonization first, and then bridging the gap to energy transition. And, our view is that these energy companies, or whether the oil and gas companies or whatever, are going to play a huge role in that because of their expertise and all those sorts of things. But it's not recognized here as much as it seems to be in the US. Again, the sticks versus carrots thing, I think, is a huge thing. The US IRA, just offering more carrots that would make the economics make more sense.
Oh, great. And then Matt, over to you. What are some of the things that the US can learn from Canada?
Yeah, so BDC, EDC, and CIBC, I mean, Canada has a whole set of infrastructure institutions for building really big stuff in the way that the US traditionally, until very recently, has not. So, when we were building infrastructure projects, we would often bump into Export Development Canada in the way that, say, the US analog, which might be the US Department of Energy's Loan Programs Office, just isn't quite as robust or out there. There's certainly no equivalent to something like CIBC that would take an equity position in an infrastructure asset. That's still, I think, taboo in the United States for the government to have such an active role. But when you leave things to the private sector, it's maybe not as efficient or centrally planned or streamlined.
Great, thanks, Matt. And Linal, anything you want to add to this? You operate on both sides of the border.
They've summed it up pretty well there. So.
All right, great. So that leaves us with about 15 minutes to the end, and I've seen a bunch of questions pop into the chat. So please, over to the audience, if you do have questions, please put them into the chat. Shannon is going to be collecting them, and I think she'll be asking the question because she's much better at Zoom chat than I am. I'm probably going to miss some of them. So Shannon, over to you if that's okay.
Hi, everybody, and great discussion so far. Matt, I know you responded in the chat, but maybe just for the larger group, to avail 45Q credits, how important is LCA, especially if LCA is required by IRS for carbon sequestration and EOR projects?
Yeah, so just to back up on this, so LCA life cycle analysis, so this is how you count your carbon over your entire value chain. And there's 3 different use cases. The first is enhanced oil recovery. The second is non-EOR utilizations. That'd be like if you put the CO2 into concrete, for example. And then the third would be saline storage. In the case where you're putting the CO2 into a hole in the ground, your credits are based on reporting that you're already required under your geologic well permits to the U.S. Environmental Protection Agency, and that's known as Subpart RR. It's part of the Clean Air Act. So it's a thing you are already going to do, and hand wavy, you basically copy and paste that and send your Environmental Protection Agency reporting to the tax authority, and that sort of handles that. But there's not really an LCA there. That's more about making sure that you've properly accounted for how much CO2 went into the hole, but it's not going to account for, say, the emissions from the compressors on your CO2 pipeline. If you are doing beneficial utilization, CO2 into concrete, for example, that's a little bit more complicated. What we want to do is make sure that we are only getting credit for the CO2 that actually goes into the process. So if you say blow a whole bunch of CO2 through your concrete, but it's not actually trapped in the concrete, you don't get credit. So that's where the LCA comes from. Now, the tax regulator is still working on the regs. As you can imagine, telling a taxing authority to generate an LCA standard is a huge mess, right? Those entities don't have that sort of in-house expertise. And so they're still figuring it out. What that actually means in practice is that the Environmental Protection Agency, the tax authority, and the Department of Energy will have to get together and decide. And it's going to take a while.
Great. So a question came up for Jared. BMO has published a short analysis on the CCUS ITC versus US 45Q. Has there been a more comprehensive analysis comparing the 45Q and other US supports versus the ITC and other Canadian supports?
It's a great question. The answer is no. The focus so far has been on sort of the big sort of tax credits, if you will, and comparing them. I think the challenge with some of the other credits, particularly in Canada, is that there's the terms around them are still in flux. So you take the clean fuel regulation, for example, that's coming in this year. I think it's and this is part of the problem, I think, too, with investment, is that you're going to have smaller companies, smaller projects having a challenge with keeping up with all of the administrative accounting and things that go into this, because we can't wrap our heads around exactly how those regulations are going to apply in certain situations. I think some situations are more clear cut. So for example, you take a refinery that's producing gasoline. If it can prove that it's reducing its emissions or using lower carbon fuel, then you're going to get credits from that. It's less clear cut on, say, an upstream operation or other industrial processes. So it's kind of, I guess, the short making the answer short is that it's complicated, and we're not so sure of all the details at this point.
Great. It's constantly in flux is how a lot of CCUS seems to be working. And another question, an advantage of the Canadian policy for early stage solutions appears to be a lower minimum threshold for CO2 captured, converted, or sequestered. Would that be a fair statement?
What's the minimum for Canada? Sorry.
That was from Jason, if Jason knows, or Maxi.
Yeah, there's I haven't seen any details, but I do know that when the investment tax credit, for example, there's language in there that says that if they get less than $20 million, the projects, then they're not required to do detailed reporting or public learning. So it just suggests that the ITC, for example, the investment tax credit is available to very small scale CCS projects.
I mean, I just find small scale CCS to be a little bit of an oxymoron, because remember, in almost all cases, you have to get the CO2 to a hole in the ground. And the economics of holes in the ground generally points you to massive, massive scale. So that's not to say you couldn't have a distributed network of capture operations and then truck it, for example, to a central geologic repository. But, if you look at the 45Q threshold, you're now covering well in excess of 90% of emitters. In their respective categories. It's just not clear to me why that there'd be an economic case to go any smaller. I don't think that that's like the hill to die on.
I think that Linal probably has some better insight into that with some of the projects they're doing with Synovus and others. But I'll just chime in really quickly and say that in Alberta, for example, there are some cases where, like currently, for example, there are projects going ahead in sort of gas processing facilities, for example, where they have local storage. And so modular application where you're using basically an acid gas injection well instead of an actual hub sort of model development. You don't have to transport the CO2, then the economics can go around. But I'd say you're right that overall, in the grand scheme of like net zero and these big hubs, it's sort of irrelevant.
I think Jason's point is, he's putting in the chat, I'm just speaking it out because not everybody's going to see it, is that the point is that we need a lot of field and pilot projects still to demonstrate this technology, especially for the most challenging applications, and that the Canadian approach potentially has an advantage there in enabling this first deployment. Maybe Linal, you work exactly in that space. Is that something that you're encountering?
I guess from a scale perspective, I mean, Matt kind of hit it right on the head. It's economies of scale is your friend when it comes to these sort of projects. And just to put numbers to it, and when we were strategically trying to figure out where we wanted our commercial scale RAMs to be developed at, the sizing was based off of basically what made sense from a dollars per ton for capture. And that's why we're going after 500 tons per day and greater, because that's kind of like the sweet spot of where it makes sense, especially with the incentives that are today and what we can do from $1 per ton for capture and then transport and either permanent storage or utilization. Below that, it's just this curve that goes straight to the moon. So realistically, it is something that will eventually get done, especially as technology prices go down, as more hubs get developed, so that when you have a pipeline that's being developed, it's not just for that small emitter. You're not going to develop a pipeline for 100 tons per day. That's just not feasible right now, especially if you add distance to it. Once you start having more of that infrastructure in place, that's just a tie-in that you're worrying about, then yeah, but you're going to start at the large scale emitters to build those things out. And I think that's more where that's being driven.
Great.
Yeah, I mean, I think to Jason's point, I mean, it's a fair point in terms of, for the field pilots and demonstrations, I suppose. And of course, just a point, I guess, for the audience, there are a number of different financial supports in, both federal and provincial level that are specifically designed to help those early stage projects as well.
For sure. And realistically, for those smaller projects, just to be clear, they are being developed in a different way, but they're not being developed across the board. So our small scale demonstration facilities, the captured CO2 isn't being transported and then sequestered. Like, it just doesn't make sense to do it at 30 tons per day or 1 ton per day. they're still demonstrating the technology and the capabilities across the board, especially for utilization firms. Those are massive ways of showing off that, hey, we can take 90% and put it into concrete, or we can take 90% and make it a liquid fuel. Those are the only ways that you can jumpstart and de-risk those solutions coming to market and getting scaled up. But you're not demonstrating the full value chain at small scale. It's just not feasible right now.
Yeah, I was going to say catch and release is the term that gets used. If you go trial at the National Carbon Capture Center or the test center in Wyoming, and Canada has its own set of test centers, and you have Carbon Next, Jason, your accelerator is a great link into those. I think the key thing to remember is that it's not like if you do this and you somehow magically figured out the whole value chain at 30 tons per day, you would also just automatically pop in and get 45Q tax credits, right? Like, there's a lot of work that goes into structuring one of these partnerships and transferring the credit to some other entity. And like, it's generally just like the juice isn't worth the squeeze unless you're meaningfully large, right? I mean, infrastructure sort of doesn't get done at less than $100 million scale. So Cooper, I think my response there would be more like, let's think about like, what's a pilot where you're retiring technology risk on a catch and release basis? And then when are you building a revenue generating infrastructure asset that is of a larger scale? And, you know, you might have to take an uncomfortably large jump. That's part of what Tuatara helps you fund across. I had to put in my own plug, right?
It looks like we have one more question. Is there an issue of regionality in terms of CCUS feasibility in Canada? For example, there is currently no legislative framework that would allow for offshore CCUS in Nova Scotia, despite the fact that there looks like there is significant potential. Do you see this gap as being a barrier? Or maybe Linal or Jared?
Yeah, I mean, yeah, I think regionally there's some disparity in terms of what the potential is, for sure. In Western Canada, that's where 99%, of the exact percentage, but the vast majority of the storage capability is. And so, you know, I would agree that that's a bit of a concern, and I don't know long term whether that means that you know, Alberta would be used as a hub for long distance CO2 from other regions of Canada. I guess that's always a possibility, but yeah, there is regional disparity for sure.
Very much so. A lot of the projects that I'm aware of that are moving forward are Alberta centric, just because the Alberta trunk line is there. A lot of sequestration is being developed and permitted so that it can move forward across the board. Whereas none of that is really available for Nova Scotia. It's more potential plan. Even Ontario, realistically, it becomes a conversation of where you put the CO2 again. And there's only certain areas, especially going in that region, where it kind of makes sense to develop because there's enough emitters that you can develop a pipeline that, again, you get to scale where it makes sense, as well as you have a place to put it where, again, it makes sense. But those are still conversations that are more next 5 years probably. Whereas Alberta, you can start planning today, and realistically, there are emitters that are very much in that sector that are very much moving forward. Suncor, and various others that have assets of scale, and they are able to connect, and it works out. So yeah, there's definitely a difference, but like Jared said, there's probably opportunity for short-term transportation of getting those projects off the ground potentially.
Great. We're getting close to our time here, so thank you everybody for your insights and discussion today. Seen lots in the chat, people very excited about this conversation. I just want to share a couple more things before we sign off about Carbon Next and our upcoming program. So our January Carbon Talks is going to be looking at the results of COP27 and what it means for CCUS. We have 2 really great speakers already booked for that as well, so we're very much looking forward to that. And as I mentioned earlier, we have our cohort onboarding now. The onboarding application period closes January 13th. So if you are a venture looking for support, please reach out. I will put my email in the chat as well if you need more information on that. And we have our monthly Carbon Next newsletter. So if you want to stay abreast of what we are working on, please sign up to get our monthly newsletter. It's a very short bite size of what's going on in the CCUS space across Canada and sometimes the US or international if there is large news to be discussed about that. So thank you, everybody. And I hope you all have a great holidays and get some time off. And thank you again to our panel for participating today.